I was in the sauna this morning and a guy sits next to me. We start talking and he tells me that he's a mortgage banker. So I ask him, how's business doing? And what he tells me is, quote, we're all getting ready for the party to start. The housing market has been extremely slow the last few years. Why? Because if you wanted to buy this house in 2020, you would pay $400,000 to buy this house and you could get a 30-year fixed rate mortgage at 3% a year. Fast forward 5 years, that exact same house is not going to cost you $400,000. You're going to have to pay $600,000 to buy the exact same house, and you can't get that same 3% mortgage. Instead, you're going to be paying close to a 7% mortgage for a 30-year loan. That means if you put 20% down, $80,000, your monthly mortgage payment was $1,420 on this house in 2020. Today in 2025, if you bought that same house, 20% down is $120,000, and now your mortgage payments on that exact same house are not $1,500. It's going to be $3,190, which means unless you're making 2 times more money than you were in 2020, you've essentially become poorer in the eyes of the housing market. Not to mention that now that your house is more expensive, more valuable, your property taxes are more expensive, and your home insurance prices are a whole lot more expensive. But now it looks like a lot of bankers and realtors believe that the housing market is about to start booming again, because after a lot of consistent pressure by President Trump, it looks like we might be getting lower interest rates in the near future. That's why in this video, I want to break down what's happening and what might be coming. That way you can be prepared. Back in 2020, the housing market, like the rest of the economy, flipped upside down when our central bank, the Federal Reserve Bank, cut interest rates all the way down to 0. Now, just to make sure we're on the same page, when I say interest rates, I'm not talking about the mortgage rate that you pay. I'm talking about the interest rates that banks have to pay to borrow money. So when the Fed cut interest rates all the way down to 0 in 2020, that meant your mortgage also got a whole lot more cheaper. And so in 2020, the average mortgage rate in the United States was around 3.1%. In 2021, it was the exact same. And this cutting of interest rates coupled with a bunch of free money led to the biggest boom in the housing market that most of us have ever seen in our lifetimes and our parents' lifetimes. So between 2020 to 2022, the technical word for this period was it was a party time for everybody in the housing market, for mortgage bankers, for realtors, for title companies. Everybody was selling houses and making a lot of money. And that was when the party stopped. In 2022, the Federal Reserve Bank stopped this housing market party because in 2022, the Federal Reserve Bank started raising interest rates, and they raised interest rates 11 times to help cool down inflation and to cool down this economy, which was clearly overheating. That meant that you could no longer get these 3% mortgage rates, and we slowly saw mortgage rates go up from 6% to around 7% in 2023. At first, everyone said the housing market's gonna crash because nobody can afford a house at this price with a 7% mortgage. And yes, we did see a severe slowdown in the number of home sales because a lot of people did get priced out because they couldn't afford a 7% mortgage, but people kept buying. Sellers didn't cut the prices of their homes, and home prices kept going up in 2023. And this is where everybody that worked in the housing market industry started to get concerned. Mortgage bankers got concerned, realtors got concerned, because now when people aren't buying houses, well, that means these mortgage bankers and realtors aren't getting a commission because they get paid only when a transaction happens. And that was when every major agency, the mortgage bankers and the National Association of Realtors, put up predictions in 2024 that mortgage rates are going to be falling to 4 or 5% very soon. But that didn't happen. If you were subscribed to Market Briefs, you know that in 2024, it was the slowest housing market that we had seen in decades. But again, it was a very strange tug of war. Buyers were saying, we can't afford these high home prices with the 7% mortgage. And sellers were saying, okay, well, I'm just not going to sell my house because nobody else has a house for sale. So I'm just going to sit on my house and not sell. Now, fast forward to 2025, and we are starting to see a softening in the housing market because we're starting to see more home listings hit the market. We're seeing less buyers, and we're seeing more price cuts happen. And this is one of the reasons why President Trump has been demanding lower interest rates to help boost and stabilize the housing market, because we know that a lot of people are employed through the housing market. and looks like we could be seeing lower interest rates coming soon. And this is where it helps to understand why we might be seeing lower mortgage rates coming soon. We've been explaining this in Market Briefs. Again, Market Briefs is my free financial newsletter for investors, where every day my team is working to break down what's happening in the housing market, stocks, crypto, global markets, and our own economy into a fun, witty, and easy to read newsletter. It's read by hundreds of thousands of investors every morning. It's completely free, and when you join, you will get access to my investing masterclass as a complimentary bonus for free just for joining. You can read Market Briefs in less than 5 minutes every morning. So if you want to join Market Briefs, all you have to do is click the link down in the description below to sign up for free. The reason why many people are anticipating lower mortgage rates come 2026 is because President Trump wants to replace the chairman of the Federal Reserve Bank, Jerome Powell, with somebody who is going to be much more aggressive on cutting interest rates. Again, when we talk about interest rates, we're talking about the interest rates that banks are paying to borrow money. And if banks borrow money at a lower interest rate, they can, in theory, charge you a lower mortgage rate as well. Now, maybe the Federal Reserve Bank will cut interest rates some in 2025, but the chairman of the Federal Reserve Bank, Jerome Powell, is not going to see his term expire until 2026, and that's when it looks like President Trump would be replacing him. So now, if we think about what does this mean for the future of the housing market, if we start to think beyond 2025, let's take a look at supply and demand, because the price of anything, whether we're talking about stocks, gold, or real estate, ultimately depends on supply and demand, because when you have more buyers than sellers, everybody wants to buy a house, well, that's when you start to see the bidding wars and people are bidding $100,000 over asking price. That's what we saw happen here. When you have more sellers than buyers, which is what we're starting to see right now, well, now sellers are having to compete against each other to get a buyer, and the way that they compete in the housing market is through cutting prices. Now, the interesting thing about this is you will generally see housing prices go up faster than they go down. Why? Because when a lot of people want to buy a house, they will overbid against each other. And if you own a house and somebody offers you $100,000 over asking, you're not going to say, oh, that's too much money, just give me $5,000 over asking. You're going to take the higher price. So when people are overbidding, home prices go up faster. But if you have the same house, it's on sale for $400,000, and somebody gives you a $350,000 offer, $50,000 under asking, you're going to say, how about we keep the house on the market a few weeks longer? How about we see what happens? How about we just don't sell it? That's why housing prices go slower downwards than they go upwards, because sellers are going to gladly accept higher prices, but they're not going to want the lower prices that easily. But now, when you start to see lower mortgage rates, if we start to see them happen soon, that could impact demand, but it could also impact supply. The reason why it can impact demand is pretty obvious, because if mortgage rates go from, let's just say, 7% to 5%, 4%, who knows? We don't know where they're going to go yet. Well, a lot of people might say, that $400,000 house that was really unaffordable because of that really expensive mortgage payment now becomes a little bit more affordable. Maybe we should thinking about buying a house now. So we could see more demand if interest rates and mortgage rates fall. But you can also see something similar happen on the supply side. Now, we finally, in 2025, towards the second half of 2025, started to see more sellers than buyers in the market. This took a long time to actually start to see more listings hit the market. But now, if we do see lower mortgage rates, that could mean that sellers that were thinking about moving into a new house might feel a little bit of relief, because the big concern that a lot of sellers had is, hey, I bought a house at a 2.5% mortgage rate. If I buy a new house today, I gotta pay 6.5% or 7%. I don't wanna do that. Maybe we'll just stay in this house longer. But if mortgage rates fall, then that same seller might say, hey, I got this 2.5% mortgage rate. If I have to go to a 4%, even maybe a 5%, it's not as bad as a 7%. Maybe we should think about selling and go to that bigger house or the smaller house or into the new city that we're thinking about moving into. So that's where lower interest rates can also work to increase supply. And we will ultimately see what happens, but if we see more demand than supply, if we see more buyers come out of those sidelines and they start buying houses again, that could start to push home prices up as well. But it's going to be balanced with supply, because if you balance the supply with demand, meaning you have more houses being built, more construction, more availabilities, while there's more buyers, well, then that could balance the housing market and make it a little bit more affordable. But it doesn't always work very linearly, because in theory, yes, if there's more houses and you're paying the same amount of money with a lower mortgage rate, you're getting a cheaper house. But if home prices go up and you're justifying the purchase because of the lower mortgage rate, yeah, you are saving some money on your monthly costs, but you have to borrow more dollars in order to make that happen. And in all of these instances, the person that wins are the people that are working in the housing market, because that means the realtors, the mortgage bankers, the title agencies, everybody that's working on commission and on the number of transactions would be benefiting, because if mortgage rates go down, you bet there's going to be a lot of people refinancing. You bet there'll be more people transacting, and that can help the industry get moving again. So what's going to happen? Ultimately, time will tell. If you want to stay up to date on what's happening, when it's happening, Market Briefs is a free resource. I have the link for you down in the description. And if you enjoyed this video, the best thank you is to share this with a friend. America is entering a death spiral.
When debts rise relative to incomes on a chronic basis, right now for the U.S. government, it's almost $1 trillion a year that goes to interest payments. When you run a large deficit, you have to sell debt to do that. And when I calculate it, the quantity of debt sold to be sold is much